Do you think that monetary policy, interest rate policy, should take financial stability into account as well as unemployment and inflation?
Thank you, Marty. So the question of whether monetary policy should be used to address financial stability is one in which there are really two schools of thought among monetary policy thinkers and policymakers. And I think the majority view is what Marty just articulated, is that monetary policy has already got two goals: stable prices, maximum employment. Best to use regulatory and macroprudential regulatory policies to address financial instability. And so I would certainly agree that monetary policy is not a great tool to address that third concern, and that it's far preferable to use supervision and regulatory tools to address financial stability to the extent that we can. It's not ideal to add a third objective, and it's not a tool that fits particularly tightly with the objective of financial stability. On the other hand, I think it's hard not to keep in mind as a policymaker that the last several business cycles in the United States have not ended because of high inflation. They've ended because of financial imbalances, if you will. The savings and loan crisis, the dot-com bubble popping, and then the mortgage bubble popping, and the global financial crisis. So these were not the traditional way business cycles generally ended, which was high inflation and that sort of thing. So it's hard not to have that in the back of your mind. And there is a theoretical and to some extent an empirical connection between low rates and credit growth and asset prices. It's not clear, it's not decisive, but ultimately I am in the camp of thinking that monetary policy is not at all the ideal tool to address these questions.